The bond market just sent a message, and most people completely missed it. We're talking about the moment when the safest asset on the planet started losing its crown, and the ripple effects could touch everything from your mortgage rate to your retirement account. Let's start with the number that should make everyone stop scrolling: $39 trillion. That's the current national debt. And we're adding roughly $2 trillion more to it every single year, like we're on some kind of fiscal subscription service we forgot to cancel. Here's where it gets genuinely uncomfortable. Interest payments alone are now approaching $1 trillion annually. To put that in perspective, we're spending more just to service our debt than we spend on the entire defense budget, which is saying something given that we just got dragged deeper into a war with Iran. Now, you'd think that all this borrowing would be fine because, hey, it's the US government, the gold standard, the safe haven, the thing every panicked investor runs to when markets get weird. But here's a twist. The International Monetary Fund just told us that the so-called convenience yield of US Treasuries has actually gone negative. In plain English, that means Treasuries once so premium, so desirable, that investors accepted lower yields just to hold them are now sometimes yielding more times than equivalent bonds from other developed nations after currency hedging. The safety premium evaporated, and now we're paying a discomfort fee. Think of it like being the most popular restaurant in town for 40 years. Then one day you notice the line is shorter, the Yelp reviews are slipping, and the place across the street, the one nobody talked about, is suddenly fully booked. The World Bank and the European Investment Bank just auctioned bonds at yields nearly identical to Treasuries, and investors showed up in droves. What changed the demand picture is almost as interesting as the supply problem. Global central banks, once reliable and boring buyers of US debt, have been quietly stepping back while hedge funds, those famously patient and altruistic institutions, have stepped in to fill the gap. If that last sentence made you nervous, it should. Hedge funds aren't buying treasuries because they believe in the American dream. They're running basis trades, arbitrage strategies, and momentum plays that can unwind violently and suddenly. We saw a preview of that dynamic in March of 2020, when the Treasury market briefly seized up and the Fed had to flood the system with liquidity just to keep basic financial plumbing functional. History loves patterns, even when participants swear each cycle is different. And this one rhymes uncomfortably with the late 1970s and early 1980s, when spiraling deficits, geopolitical chaos, and supply shocks pushed yields to levels that seem almost mythological today. Paul Volcker had to break the economy to fix inflation back then, and we're nowhere near having that kind of political will sitting around right now. Here's the misconception worth addressing head-on. A lot of people assume rising treasury yields automatically mean a crisis is imminent, or that the dollar is collapsing. That's not necessarily true. Higher yields can reflect higher growth expectations. And the US still has unmatched legal infrastructure, liquidity depth, and reserve currency privilege that doesn't disappear overnight. What this times mean practically is that the calculus for every other asset class is shifting. When the risk-free rate is elevated and the safety premium of treasuries is eroding, spreads compress, corporate bonds from big tech AI hyperscalers start trading almost like treasuries themselves, and suddenly the entire pricing architecture of global debt is being recalibrated in real time. The actionable lesson from every historical episode like this is remarkably consistent. Don't make dramatic all or nothing bets on a single outcome. Size your positions so that being wrong doesn't destroy you, and let the process do the work rather than your conviction. The people who got wrecked in past bond dislocations weren't always wrong about the direction, they were wrong about the timing and used too much leverage. Discipline, sizing, and consistency are the only edges that survive long enough to matter, because macro calls are notoriously humbling, and the graveyard of "this time it's different" trades is very, very crowded. We can be comfortable with multiple outcomes here, as long as we've done the rational preparation. Understanding duration risk in our portfolios, knowing what rising rates do to real estate valuations, and not assuming yesterday's safety is tomorrow's guarantee. Whether this resolves through gradual fiscal reform, a dollar realignment, or a proper bond market tantrum, the structure of opportunity in real assets, particularly real estate, actually strengthens when paper assets lose their luster. The world is repricing safety, and that's your cue to understand where you actually stand. And if you want help figuring out where to go from here, whether that's real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.